This house in Manchester just sold for £220,000. But when our client bought it just 2 years ago, they paid only £180,000. How is that possible? Well, because 2 years ago it looked like this. Our client invested in an off-plan property. And while it might seem risky to invest in something that doesn't actually exist yet, we've helped arrange thousands of successful off-plan property purchases over the past 12 years. So in this video, I'm going to walk you through why buy off-plan in the first place, the risks you need to watch out for, and 6 essential checks you need to do before you sign anything. Before we get started, we need to talk about the pros and cons of buying a custom sofa. You can't see it in person, you can't test how comfy it is, and you won't know exactly what it looks like in your space until it turns up at your front door. But if you've done your research, checked the reviews, and bought from a trustworthy brand, you can end up with something far better than you'd get in IKEA or Argos. You've locked in the price, got something that suits you perfectly, and avoided the hassle that comes with browsing every sofa site on the internet only to find nothing quite right. And hopefully you get your measurements right so you don't have to remove the living room window just to get it in the house. Buying off plan works the same way. You're putting down money up front for something that doesn't exist yet or is only some of the way there. It sounds risky, and it can be. But when you do it right, it can be a smart, strategic way to get ahead of the market. Because while most buyers wait until a property is finished before making a move, you get to jump the queue. You lock in today's price, not the one it might have risen to in 18 months' time. And if property values do go up in the meantime, that growth is all yours, even if you only put down 10% to reserve it. If you're working with a sourcing company, you might even be able to secure a discount on its value today, meaning you're starting off with built-in equity from day one. I know what you're thinking though. If the market is so competitive, why would a developer offer such a deal? Well, they do it because it helps them too. Lenders often see off-plan sales as proof that there's demand for the project, which helps developers secure cheaper funding and get the build moving faster. And in some cases, your deposit itself can fund the construction. But as I'll explain in more detail later, this is something which can cause problems further down the line if you're not careful. Now, a lot of people watching will have a strong opinion that buying off-plan is way too much of a risk because they've heard the horror stories from people who didn't do the right checks. But it doesn't have to be a gamble. Over the past 12 years, we've helped clients safely arrange thousands of off-plan purchases, and we've seen what works and what doesn't. So before you dismiss it as too risky, let's walk through 6 things that catch most people out and how to avoid them. Let's start with something we see all the time, especially when new developments are marketed overseas. A developer announces a new block of apartments in the city centre. They slap a £300,000 price tag on each unit, only to knock it down to £270,000 as a special launch discount. Sounds like a great deal, until you realise there was never a world in which they were actually going to be able to sell them for £300,000. It's a pricing strategy designed to create a sense of urgency and value, especially for overseas buyers who might not know the local market well enough to spot the difference. And this is more common than you might think. We've seen plenty of deals where investors thought they were buying at a discount, only to discover they'd actually paid well above the going rate for that type of property. So what can you do? Well, it's your job to figure out what the true market price is, not just what the developer says it is. You can start by comparing it to similar properties nearby that have already been built and sold, focusing on sold prices, not asking prices. You need to know how much buyers are actually willing to pay rather than the amount developers are hoping to get. If you're thinking of buying on a multi-phase development, then that could help you to get an even more accurate figure. Look at the land registry to see what homes in earlier phases sold for, or ask to see proof of recent sales. For example, we recently secured a deal for our clients in Manchester where we knew for sure that our 7% discount was solid because we'd seen proof of 30 sales that had all happened at full price over the past few weeks. Without that, if it's a high-end city centre project with nothing quite like it nearby, it can be harder to get an accurate price without experience and local knowledge. Either way, don't assume the discount is real just because the brochure says so. If the numbers don't stack up compared to the wider market, it's not a deal. It's just marketing. And just before we get to the next mistake that can trip you up, if you're considering buying off plan, we've put together a free checklist for buying off plan in 2025. It's the exact checklist we use with our clients to spot fake discounts, protect deposits, and avoid common off-plan mistakes. You can grab it using the link in the description and use it to double-check any deal before you commit. Now let's talk about something that keeps even the most experienced investors up at night. What if the developer just doesn't deliver? In our experience, outright scams are rare. It's unlikely that the developer will run off with your deposit. But developers running out of money, going bust, or failing to finish what they started, That happens more than you'd think. In fact, we were recently contacted by someone who'd put down a £40,000 deposit on a flat, only to find out that the developer had gone into administration. Worse still, her solicitor told her there was very little chance of getting the money back. The most painful part? 2 minutes on Google, and we'd found a string of dissolved companies connected to the same directors. It wasn't just bad luck. There was a clear pattern of failure, and the investor hadn't been aware of the risks. So, how do you avoid ending up in the same situation? Start by digging into the developer's history, because you can learn a lot with just a few small checks. Go to Companies House and look for things like overdue accounts, strike-off notices, or patterns of short-lived companies. Then check out the directors. What other companies have they been involved with? Are they still going strong? Look at their past projects. Were they completed on time? Are there any reviews or media coverage? And one last thing, if you're new to buying off plan, approach first-time developers with caution. Because you're not just investing in a property, you're investing in the team behind it. And even the most well-meaning team can run into problems if they don't have a track record of seeing projects through. So you need to protect yourself. And I'm about to share one of the quickest and easiest ways to do just that. So at some stage in the process, you'll be asked to hand over a deposit. That's to be expected. But we had a question come into our Sunday Times column recently that perfectly illustrates where this can go wrong. A buyer was being asked to put down 25% now and another 25% a year later, long before completion. With a structure like that, it can only be because the developer needs that much money to fund the build itself, which might sound logical until the money runs out before the build is finished. Because an 80% finished flat isn't of any use to anyone. If the project fails and there's no protection in place, that deposit is gone. No refund, no insurance payout, no investment. That's why we always insist on one of two things. Either your deposit is held in escrow by a solicitor or independent third party, or it's protected by an insurance policy, one that pays out if the developer fails to deliver. Without one of these protections in place, you're taking a leap of faith with tens of thousands of pounds on the line. So, as tempted as you might be to rely on trust and positive reviews, you need to prepare for the worst. Make sure your deposit is properly ring-fenced just in case. But before you do that, there's something else you need to do to avoid the risk of losing money. Because here's the issue. The bigger your deposit, the more exposed you are to risk. If the project hits delays, goes over budget, or the developer gets in trouble, which does happen, your money could be tied up for years. In some cases, the development might be stalled for years or even cancelled altogether. We've had clients who found themselves in this very situation through no fault of their own. But because they'd limited the amount they were willing to pay up front, they didn't lose their deposit. Which is why we have one golden rule. Never put down more than a 10% deposit. And we haven't plucked this figure out of thin air. We've chosen it because it's the maximum amount that warranty schemes will cover. Up to that amount, your deposit can be covered by insurance, so it's returned to you without fuss if the developer doesn't deliver. Go beyond that, and you're investing without a safety net. But even if your deposit is protected and the developer knows what they're doing, there's still another thing that can go wrong. And it has something to do with the amount of time it takes from paying your deposit to completing your purchase. It could be 18 or even 24 months before the property is ready, and a lot can change in that time. You might change jobs, your income might drop, you might take on new commitments that affect your affordability. And even if your situation stays the same, lending criteria might not. A lender that will say yes today could say no in a year's time, especially if the economy shifts or if they change their policy on certain property types. And this is important because most mortgage offers only last a few months. So you can't line up when you commit to the purchase and still have it in place by the time it completes a year or more later. We've seen cases where buyers are left scrambling at the last minute when their mortgage falls through. And that's why we bring in a specialist broker right from the start. Someone who knows how to assess both the deal and you from a lender's perspective. They'll look at the build, the timeline and your circumstances to give a realistic picture of your future options and what could affect them down the line. So here's what we recommend. Speak to a broker before you reserve anything. And not just any broker. Find someone with off-plan experience who can flag potential risks early. Make sure you have more than one lender option. If you're relying on a single provider, one change in policy could bring the whole thing down. And have a backup plan. That might mean reducing your loan to value by putting in more cash, switching lenders, or lining up alternative finance. Know what your options are before you need them, because a mortgage in principle today doesn't guarantee a mortgage offer tomorrow. especially when tomorrow could be 2 years away. Hopefully you're starting to see why buying off plan can be such a smart move. The potential for capital growth, the chance to lock in a discount, the ability to secure the right property before anyone else even sees it. But let's be honest, it's not for everyone. If this is your first time investing or you're just naturally cautious, the idea of buying something that doesn't exist yet can feel like a step too far. Because while most off-plan investors assume that deals are only there to be done at the very beginning, there's another window of opportunity that's far less talked about, right at the end, when the project's almost complete and the developer is keen to wrap things up. By this point, a lot of the uncertainty has gone. You can see real progress on site and maybe even view a finished unit or one from an earlier phase. You might also be able to get your hands on more accurate sales data, making it easier to know whether you're getting a good deal. And at this stage, the developer will usually be keen to shift the last few units, get off site and move on to the next project, which means you can still get a discount, just with far more certainty about what you're buying. No, you won't have as much choice when it comes to layout or floor plan, and the price might be higher than if you jumped in early. But for many investors, especially first-timers, that trade-off is well worth it because it gives you all the benefits of a plan with a lot less of the stress. So now you know exactly how to protect yourself when buying off-plan. But even the best process doesn't matter if you're buying in the wrong place, because the perfect deal in a poor location still won't make you money. So watch this video next, where we show you the 4 worst cities to buy in 2025.